present today on this Sunday morning for the Valuation Manthan session number 13 on the topic of valuation of intangible assets. I, see Anisa Kazi, welcome you all on the behalf of the Valuation Standard Board of Institute of Chartered Accountants of India under leadership of our chairman, C.A. Hansraj ji. We have with us our honorable speaker, C.A. Apeksha ji, who will grace today's session by sharing her enriched knowledge for the benefit of all those participants present today. I kindly request our chairman, C.A. Hansraj sir, to welcome the audience.
Thank you, Anisa. I welcome each and every participants, those who are joining on a regular basis. This program or the series of the programs, which is really getting a momentum and participants running into thousands. And today we are in the 13th in the row, and many more to go to equip ourselves to really understand the gimmicks of the valuation side for the whether under the regulatory requirements wherever it is required without the general business and the commercial needs. Fortunately, the speakers across India from the different locations, we find those who are experts. Today we have a CA Apeksha Kukreja, and she'll be guiding us on the valuation of intangible assets. Naturally, if we talk about whether the different sessions taken so far, whether it is the tangible, intangible brands, the IPOs, or in the startups, many things we have already understood with, and many will be lined up for the benefits of the membership joining us across India and maybe many from the overseas also. Friends, the series is whatever is going on with the support of my co-chairperson, though she is not joined yet, she may be joining at any moment. Preeti Savla, she hails from the western part of the country. She is from Mumbai, and she put the best to bring out in the system many newer things. In the committee also, we have many things are being lined up with the support of our secretariat. Two officers from the secretariat, Rahul and Dimple, is with us. Jay, welcome you also. Welcome everyone. And this committee, this board as such, with the standardization of the parameters to develop an ecosystem where its variance should be get away and some standard system to be taken up. This board has developed standards in the system which are naturally taking us as a guide to the chartered accountants. They have to mandatorily follow the standards, and many things are being lined up. I'll request each and every participants, if they have some kind of interest to engage with the this board as such, whether for the review of the standards or getting into the newer standards to be developed, and many things are being planned, whether it is the not limiting to the financial assets, but going forward with the land and building and the assets which we talk about the plant and machinery also. In the time to come, we are expanding our horizons and bringing out so many good things for the membership and for the sake of the development of the business needs also. So with this kind of understanding and the initial remarks, I once again welcome each and every participants, welcome the speaker also, welcome our moderator of the program also, welcome the team from the office also, and the tech team also, tech support people also. And now over to Anisa. Over to you now. Anisa, you are on mute.
Am I audible now? Yeah. The brief description of our speaker, Ms. Apeksha ji. We have with us Apeksha ji, who is a valuation professional, and she is employed with PwC for 15 years. She has been All India ranker in CA examinations. Her major focus area is merger and acquisitions, including business and equity valuation, taxation and regulatory valuations and bid advisory. She has immense experience in the valuation of complex derivatives and financial instruments and financial models. With this brief introduction, I request Apeksha ji to start the session and guide us all present today with the experience and knowledge.
Thank you, Hansraj ji and Anisa ji, for the warm welcome. Hello, friends. My name is Apeksha Kukreja, and today we will be conducting the session on valuation of intangible assets. I'm joined by my colleague Jay Ponda, who is also a CA. Jay, if you would want to introduce yourself, please.
Yeah, good morning everyone, and thank you Hansraj ji and Anisha ji for giving us this opportunity. My name is Jay Ponda and I'm an associate director in the valuations team and have an experience of 11 years doing valuations. So thank you for the opportunity again, and over to you, Apeksha.
Thank you, Jay. So with this, let me just share my screen and start the session for today. Please let me know if my screen is visible.
Yes, ma'am.
Okay. So, valuation of intangible assets. The topic we will cover today by understanding and getting an overview of intangible assets, different methods of valuations, and then we will have a brief session on question and answers. So, what are intangible assets and in what context do we encounter intangible assets in our professional lives? While we go into the definition of intangible assets, I think the most common encounters with intangible assets particularly happen in a business combination. When one entity acquires another entity or another business, as per our Indian accounting standards, there is a requirement to fair value all the assets and liabilities, whether tangible or intangible, of the acquired business and to record those at fair value in the books of the acquirer such that the purchase consideration is allocated between the tangible and intangible assets of the acquired business at their fair value. The residual is called the goodwill. Now, with this requirement set out by our accounting principles, our accounting standards, there is a requirement to value intangible assets. In other contexts, one may come across intangible asset when maybe such an asset is given as a collateral for bank borrowings or for funding purposes, or in other cases where one business acquires intangible assets of other business purely from a business perspective. Say, for example, Hindustan Lever acquiring the brand and formula behind Indulekha hair oil and the associated technology behind it. So these are the general instances where we come across intangible assets, and the requirement to value these intangibles can be divided into two frames. One is for an accounting purpose, where for financial reporting purpose, the acquirer is required to record these tangible, intangible assets at their fair value. And on the other hand, from an income tax perspective, where these valuation of these assets may be required to determine the tax incidence. Or the third instance, which I mentioned, where these intangibles may be required as a collateral for arranging funding or bank borrowings. Now, what are intangible assets? We understand that intangible assets are identifiable, non-monetary assets which do not have a physical substance, but they grant the right or economic benefit to its owners. Goodwill is an economic benefit which has not been separately recognized as another asset. The goodwill is typically measured as the residual amount after considering value of all identifiable assets and liabilities. The critical attributes of an intangible asset are identifiability, control, and future economic benefits. When we say identifiability, the intangible should be separated, should be separable and be capable of being sold, transferred, licensed, rented, or exchanged on its own. Or it may arise from a contractual or legal right. When we speak about control, the owner of the intangible should be able to obtain future economic benefits and restrict the access of others to the benefits arising from the intangible asset. Most importantly, the owner of the intangible should be able to get future economic benefits from the intangible arising from the ownership. This can be in form of revenue from sale of products or services, cost savings, or any other benefit accruing to the owner. So, in a nutshell, an intangible asset shall be recognized if and only if it is probable that the expected future economic benefits attributable to the asset will flow to the owner and the cost of the asset can be reliably measured. Now, why are intangible assets valued? We spoke about it briefly, and here is a summary of all the instances where we typically come across instances of valuation of intangible assets. The first one being accounting and financial reporting purposes. Ind AS require under the business combination standard require measurement and recognition of intangible assets at fair value. When there is a transfer or a taxation of intangible asset, the income tax regulations require the transaction to be at a fair market value and to determine the tax incidence, if any. Any transaction, any M&A or individual sale or purchase of an asset between two independent parties also requires a valuation. We spoke about financing where the intangible may be recognized as a collateral. Say, for example, if it's a very well-known brand, it can be utilized as a collateral to arrange for bank borrowings for the owner. In case of litigation or dispute, where again the settlements may be linked to the fair valuation of the intangible, and for general consulting and support purposes. Now, various instances where intangible assets are required to be fair valued. Let's look at the categories of different intangible assets. We may come across intangibles like technology, brand, customer relationship in our day-to-day conversations also. But let's deep dive into how these are categorized depending upon their very nature and construct. So when we look at intangibles, they can be classified into customer related, marketing related, technology related, and there are other few categories. Let's evaluate each one of them. A customer related intangible is created in the due course of business by the entity. It can be a customer contract, relationship, order backlog, or even a customer list. When we speak about marketing related intangibles, these are created by the business for the business. Any intangible in the nature of marketing related creates a distinct recognition for the business, which enables the business to differentiate itself from other operating entities in the same business. Some of these are some examples are trademark, brand, logo, service mark, domain names, to name just a few. When we look at technology related intangibles, these create proprietary knowledge. These are in the nature of the secret formula, or a recipe or a process, which enables an entity to manufacture a product or any product by which it differentiates the process of manufacturing for other entities. Any product which uses a secret method or process or formula or recipe is proprietary to the entity, the knowledge of which is not publicly available or shareable with other entities. Some of these could be database, formula, designs, software, processes, recipes, and it could be both contractual or non-contractual, patented or unpatented technology. When we speak about database in an IT company or in a business knowledge research company, the database becomes extremely important. Formula, design are important from maybe a chemical process or a pharma product perspective. Software and processes become important in any industry. Recipes, patented, unpatented technology, all of these are very critical for the differentiation of products manufactured or services rendered by an entity to make it different from others operating in the same business, or to give them an advantage, a superior quality to the product or service being made by the entity for which we are doing the valuation. There are other categories of intangibles also, which we may not come across every day in our professional lives, but these are important to know. Say, for example, artistic related, which arise from artistic work and may be non-contractual in nature. These could be books, films, plays, music, and they may also have copyright protection. When we look at contract related intangibles, these are contractual arrangements, typically in the nature of licensing agreements, non-compete agreements, servicing or supply agreements, employment contracts, and leasehold rights. Well, some of these may be recognized as intangibles from financial reporting perspective, and some of these may not be recognizable, but it is important to note that even these intangibles primarily exist. Valuation approaches and methods, and here I will invite Jay to take us through the various methods and approaches to value intangible assets. Jay, over to you.
Thank you, Apeksha. Am I audible?
Yes, we can hear you.
Sure. So, continuing on how we value the intangibles, normally there are three methods to value the intangibles similar to any business valuation exercise. The first method being the market approach, the second method being the cost approach, and the third method being the income approach. The thesis of the entire three approaches is similar to how we use these approaches for a business valuation exercise. Guideline transaction method, where an intangible is valued based on how a similar intangible valuation has taken place or a similar intangible transaction has taken place. Details of market approach in the forthcoming slide. There are two methods in the cost approach, which is the replacement cost and the reproduction cost. And the thesis of the cost approach is cost incurred to recreate or reproduce the similar intangible. The most common adopted valuation method for intangible is the income approach. The income approach thesis is you value to earn from that intangibles. There are three methods or commonly used approach. Being the relief from method. Next slide, which is on it's generally used to value intangibles such as spectrum or internet domain name. While market approach, when you value a business or when you do a business valuation, is most commonly used along with income approach because you have comparable companies or comparable transactions. But when it comes in the context of intangibles, it is used only specific to a few intangibles such as spectrum, or in case if there are comparable transactions available to kind of value this intangible. In case of customer related contracts or technology related contracts which were discussed earlier, in general parlance, getting a similar comparable transaction of the similar shape, similar size, similar economic benefits, and getting that information to value that intangibles is generally difficult, and hence market approach is considered as one of the methods to do the valuation of intangibles, but it is not used as oftenly as the income approach.
In fact, Jay, if I can just add to what you said, I think in 15 years of valuation experience, I may not have considered that transaction method or the comparable, uh, uh, you know, uh, the comparable method in whatever shape and form under the market approach at all, because like you said, paucity of information of identically comparable or even closely comparable intangibles becomes an extremely challenging job. And one, the question of comparability of the asset being valued, plus the comparable peer that we would consider. Secondly, paucity of information. Both of these are genuine problems which make market approach one of the least adopted methods in valuation of intangible assets.
Correct. So this is was the background on the market approach. Now we move on to the second approach, which is the cost approach. The cost approach, the thesis is investor will pay no more or any market participant will pay no more for an asset than to purchase or construct an asset of an equal utility. The principle is based on if I have to buy or if I have to make. In case if I have to make, what is the cost incurred uh, for kind of acquiring that specific intangible or for assessing that specific intangible. The value, so an overview of the cost approaches, you value an intangible asset based on the replacement cost of similar asset or asset having similar functionality or utility. Cost approach is generally used if intangible can be created quickly with minimum legal hassle. So in areas such as assembled workforce, when a company is acquiring 100 employees, that 100 employees can be ideally kind of hired, trained, and then they can be put to use. So generally the cost approach is used to value assembled workforce. Again, the asset approach is or the cost approach is a method used for valuing intangibles, but it's not a preferred approach because it does not reflect the earnings generating capability of that intangibles. Ideally, the intangible assets such as customer relationship, technology related intangibles, they they are acquired or they are potentially evaluated because they have a potential economic benefits in terms of future cash flows that can be earned from them. And hence, cost approach does not specifically kind of reflect that earning capability of that assets, and hence this assets or this cost approach is specifically not used for income generating capability of an intangible. The methods for valuing an intangible, the methods for valuing an intangible using cost approach, there are two methods. One is the replacement cost method and the second is the reproduction cost method. What is the difference between the two? The replacement cost method, a participant would pay no more for the asset than the cost that would be incurred to replace the asset with a substitute of comparable utility or function. While doing a valuation under replacement cost method, we should consider any direct and indirect cost of replacing the utility of the asset, any economic obsolescence, any profit markup, etc. Ideally, this replacement cost should incur both cash and opportunity cost. Reproduction cost method similar to replacement cost method. While the replacement cost is the cost to create an asset of a similar utility, the reproduction cost method is the cost to create exactly the same replica of subject asset. Say for example an internally generated software that can be reproduced with the same functions and utility. As I said earlier, the cost approach is generally used to value assembled workforce, and in some instances, cost approach is also used to value software. We move on to the next approach, which is the income approach. The income approach, uh, I'll pass on the dice again to Apeksha to take you through the brief synopsis of the income approach before I dwell into the methods which we use under the income approach.
Right. Thank you, Jay. So the income approach becomes the most important method to value intangible assets. Jay explained to us in the earlier part of the discussion where we evaluated how market approach is not suitable to value intangible assets primarily because of lack of information relating to comparable transactions available in the public domain, And with respect to the cost approach, how it does not capture the earning capability of intangible assets being valued. Income approach is nothing but a deviation of discounted cash flows, and various variants of that are adopted in valuing intangible assets. DCF in its true form is nothing but present value of cash flows generated by a business. And in case of intangible assets, it is the present value of income or cost savings or any other benefit arising to the owner of the intangible asset, which is considered in present value terms. So under the income approach, value of an intangible asset is determined based on the present value of cash flows or cost savings or income attributable to the intangible asset over its economic useful life. Most commonly used approach to intangible assets, this is what we discussed, that the income attributable to intangible assets is generally embedded in the price paid for goods or services. For valuation purpose, economic benefits associated with the subject intangible should be separated from other assets being considered. So if there are a set of cash flows attributable to a particular business, the valuer or the practitioner should separate the cash flows arising or attributable only to the intangible asset being valued and differentiate it from the cash flows of the overall business. The cash flows attributable to the intangible asset will be a subsegment of the main cash flows of the entity. The most commonly adopted methods under the income approach, depending upon availability of information, are the multi-period excess earnings method, relief from royalty method, with and without method, and other methods like distributor method and greenfield method, which are not so often adopted, but the most commonly found ones will be the multi-period excess earnings method, which we fondly call as the mean, relief from royalty method, the RFR, and with and without method. We will delve into the nuances of these methods a little later when Jay will take us through these. Now, this method is generally used to value intangible assets like technology, customer-related intangibles, trademarks, brand, franchisee agreements, non-compete, to name just a few. Now, when we adopt the income method, there are numerous considerations which are very important to value the intangible asset. These are some of the areas where most practitioners may struggle or find it difficult to take a call in terms of how should they go about these important aspects. One of the main elements is the discount rate. The discount rate or the rate of return of the intangible asset. Now, let us look at the balance sheet like in form of the arithmetic equation, which we know that asset side is equal to liability side. Similarly, let's think of how we fund the balance sheet liability side of the asset and how we deploy those funds into various assets such that the asset side is equal to the liability side. When we look at the liability side, the funding cost of the business is called the weighted average cost of capital, where we consider the weight adjusted cost of borrowing and cost of equity. These funds which have been raised are deployed into certain assets, both tangible and intangible, from which we expect certain returns. This is called the weighted average return on assets. Ideally, the asset side should match the liability side in absolute terms, and hence, going by the same principle, the WACC, the weighted average cost of capital, should equal the VARA, which is the weighted average return on assets. Once we understand this principle, it will be easy for me to explain to you how the discount rate used to value intangible assets is arrived at. So once we have established that the weighted average cost of capital is equal to the weighted average return on assets, let's take WACC as the starting point. It will be apparent to you that some assets are more risky than other assets in the business. For example, when I think about working capital is more liquid, has a shorter life, and maybe more routine with a turnaround, and hence may have a lower risk ascribed to it. On the other hand, when I look at fixed assets, which are more long term, more illiquid, may have a higher return expectation attached to them. And when I look at intangible assets, which are in fact the most illiquid, or in some cases maybe more long lived, may have a higher risk attached to them. The weighted average returns from all of these assets, where the returns have been adjusted for the risk profile of the intangible asset, result in the weighted average return on the asset. So when I look at the WACC is the starting point on which one may make a subjective adjustment to arrive at the discount rate used to value a particular intangible asset. So intangibles have a higher risk than tangible assets. They may have longer lives, which are considered to be more risky. Intangible assets may have ascertainable cash flows. Some of these may have lower risk attached to them. These intangibles may have a non-routine function with a relatively higher risk. For example, a non-compete. Or it may have, or a group of assets may be considered more risky than the overall business. Say, for example, non-contractual customer relationship. So general methodology followed is to apply an asset specific risk premium to the discount rate of the business. So like I said, WACC becomes the starting point. And on that, you may make subjective adjustment depending upon the risk profile of the intangible, whether to add a positive premium or a negative premium to arrive at the discount rate to be considered for the valuation of the intangible asset. The discount rate also depends upon various other financial parameters available. We spoke about WACC and VARA. On the left hand side of the screen, you would see the VARA, the weighted average return on assets, which ideally should equate with the WACC. But there are other considerations also which practitioners may adopt to value in the process of intangible assets. So say for example, somebody may want to consider the cost of capital to value the intangible, saying that intangibles are typically funded in-house using in-house funding. So shouldn't that be the starting point? Somebody else may say that they have taken a borrowing to acquire a brand, and the repayment profile of the debt is very similar to the life of the intangible asset which has been acquired. I have come across practitioners who say that risk-free rate with similar maturity, the risk-free rate ascribable to a government bond with a similar maturity to the life of the intangible should be used. And lastly, the internal rate of return if recent transaction has been concluded, which includes the subject intangible. Now, amongst all of the different parameters listed down on this screen, I think the most critical ones are on the left hand side of the screen, where we say that WACC, VARA, and IRR are the most critical. And let me explain. When I go back to the reference which I made to business combinations and the requirement under Ind AS to carry out a purchase price allocation, that is the most often that as valuation professionals, we come across intangible asset valuations. Under that, the consideration paid by the acquirer and the returns which he expects to make over the life of the business that has been acquired will result in an IRR, an internal rate of return, which is a market participant's expectation of running the business and getting a return. This IRR should not ideally be very different from the VARA and from the VAC, which are all based on the underlying principle of market participant view. When we look at it like that, IRR inherently should be similar to VARA and VAC. Now, whether you take IRR as the starting point to value in the intangible asset or the VAC, they would eventually converge towards VARA. So this is a mathematical check which most practitioners should keep in mind when carrying out purchase price allocations and valuation of intangible assets, that whatever negative or positive alpha we put on the IRR or the VAC, whichever is the starting point for determining the discount rate, the weighted average return expectation from all the assets put together as a business cannot be very different from either of the two, either from VAC or from IRR. And hence the equation that VAC is equal to VARA is equal to IRR. All the other aspects on the right hand side of the screen that you see are typically lesser adopted methods, because if one looks at only at cost of equity or cost of debt, when put in context of the weighted average return expectation of the business and the VAC, it may give a nonsensical result. Because at the end of the day, the intangible which is being used is being used to run a business, which in turn has been funded using a VAC. And hence the correlation between VAC and VARA has to be established, whether the starting point is cost of equity or cost of debt. Risk-free rate, usage of risk-free rate to value intangible asset, I believe is one of the most flawed approaches to take, primarily because intangible assets are not risk-free. They are in fact more risky than the individual business in which it contributes to. So if the business has a certain risk, the intangible asset is riskier than that, and hence it cannot be considered risk-free from any perspective. This, I think, is one of the crux, the main elements of intangible asset valuation. The understanding of what should be the starting point of the discount rate used to value the intangible asset, how that discount rate correlates, or what is the equation between VAC, VARA and IRR, and what are the pitfalls to avoid when looking at the discount rate. I believe this is the main crux of intangible asset valuation. Moving on, another important consideration is the economic life. Now, we as CAs and as valuation professionals are definitely familiar with economic life of intangible asset or a tangible asset. But sometimes there may be situations which makes it difficult to determine what should be the economic life of an intangible asset. It's relatively easier in case of tangible assets because there may be technical evaluations available, or the plant and machinery or the land and building may, you may find more comparable similar assets, if not in your own geography, maybe in some other geography or at some other location. If not the same industry, maybe in another industry. But you may still find precedences which will help establish economic life or technical evaluations available, where establishing economic life is easier for tangible assets relatively compared to intangible assets. Now, the elements which go into determining the economic life of intangible asset would be factors like whether it has a finite life, what are the legal terms around it, for how long will it be functioning, is there an economic or a technological obsolescence attached, or is it an asset which has an indefinite life? Now, when I speak about indefinite life, the brand Colgate comes into mind. For the past 30, 35, 40 years, the brand Colgate is synonymous to a toothpaste, right? Or when we think about photocopying, we never say, let's get a photocopy. Most Indians or most people would say, we have to take out a Xerox. The brand Xerox is synonymous to photocopy. So there may be brand assets which have an indefinite life. Let's look at an example. Now, company ABC has introduced a pharmaceutical formula protected by a patent with legal life of 5 years till 2023. Company XYZ has introduced a drug with a more enhanced formula in 2021. What is the economic life of the technology of ABC? Company PQR uses the formula of company ABC in 2025 to manufacture generic drugs. What is the economic life of the technology of company ABC in this case? Well, it is a tricky question. We have a situation where a company has a patent till 2023, but after 2023, it becomes generally available with the public, where somebody can make generic products out using that technology. And we have a situation where company PQR has manufactured a more enhanced product using a slightly different technology or a more enhanced formula in 2021. In this situation, to determine the economic life, we need to assess not only the legal, but also the economic or technical factors affecting it. And this is the situation for most of the intangible assets that we value. In this particular case, I would think that company ABC should curtail its economic benefit to 2020, the economic life of the technology up to 2021, because there is an economic obsolescence which has set in after company XYZ has come out with a more enhanced formula. But that does not mean that there is no value attached to the intangible. Of course, there is a value attached to the intangible, and it is enabling companies to manufacture products and various different products. And hence, maybe a shorter life should be considered rather than a more longish life, because there is a technological or economic obsolescence which is set in over here. So it is very, very situational. There is no rule of thumb to establish how economic life should be established. And it goes, it is extremely important. It goes without saying that we need to assess all aspects, be it legal, functional, economic or technological, and other business customs around the intangible asset to determine the total economic life. Now, let's move on to attrition. Attrition is one of the key elements in valuing customer-related intangibles. What is attrition? Attrition is the quantification of estimated loss of customers in the future. One may say that my customers have been with me for 15 years, 20 years, and is there an attrition? Well, in my experience, some businesses typically have a very high attrition rate. Some businesses may have no attrition rate at all. And in some cases, the business is so sporadic that establishing an attrition is not very easy, or there may not be enough data to establish that fact. Let's look at one example. So we had valued a company which helps various government organizations of different countries to process visa and travel related documents. The typical customers of this company were embassies or government organizations which are given the mandate of issuing visa or entry permits into their respective countries. In this particular case, the business had been operating for about 20 years, and in those 20 years, they had lost all about 2 customers. How does one take attrition over there? Another example, there is a customer of a software company which sets up ERP systems, and once the ERP system is set, the customer may come back to the company only maybe 5 years or 6 years down the line, when there are any major overhauls expected in the business process, or there is a technological change which needs to be embedded into the ERP system. So over here, the customer relationship is very sporadic. Now, in that situation, how does one ascribe an attrition rate when the customer would come to the company not more than maybe once in 5 years? Or let's look at an example of a professional consultancy firm or a financial services firm where the customer is very, there's a long-term relationship, it's a repeat customer, but the customer is extremely price sensitive and may not hesitate to walk away to the competitor of the company at any at a even a minute price change. So these factors are very specific to the business or the industry in which the company is operating, and how the customer behaves depends upon the value drivers of the business, or how sensitive the customer is to price point, to quality, to established track records, and also to an overall relationship with the organization which owns the intangible asset. Often attrition is based on historical trends and data. In the determination of attrition, we have to consider that constant loss rate if attrition is not dependent on duration of a relationship. Now, is there a constant loss rate irrespective of how long the relationship is? This is typically the case where I spoke about the visa processing company, which has lost only 2 customers in the last 20 years. Or is it a variable loss rate, which is dependent on the duration of the relationship? Say, for example, in a software company where there is a 3-year contract, the first 2 years, the customer may engage extensively with the service with the software company because the scope of work demands it like that. But by the end of the second and the third year, the engagement significantly reduces because the customer's ask is largely met, and there may be very, very specific or sporadic requests in the later duration of the relationship. Over there, is there a total disengagement, or are we able to establish a variable loss rate which is dependent on the customer relationship duration? That is important to consider. Attrition can also be different in different lines of business and geographies. Say, for example, the software company which operates in Europe may have a very strong or a sticky customer base as compared to, say, US, where it may have a high attrition rate. So when I look at the example of a business intelligence research company operating predominantly in Australia and New Zealand, it has a very low attrition rate because the industry, the financial industry which it caters, mandates such research to be undertaken and considered by financial services providers, and hence the business intelligence company which services these banks or financial institutions has a low attrition rate in Australia. But when the same company is operating in the US, which does not mandate such research to be carried out for financial service companies to consider and advise their clients on, our business intelligence company sees a high attrition rate in the US. So the lines of business and geographies may have different attrition rates. The period which is considered for attrition will depend upon the type of customer and the business of the entity. This is very specific to the business and the industry in which the target company and its intangible asset are operating. It is important to know that attrition should be ideally considered on past years along with cognizance of future estimates. It could be possible that the subject company has undertaken various steps to reduce attrition, say to improve the quality of service or to introduce new products and service offerings which keep the customers engaged and reduces the loss of customers significantly. So if there are any changes which have been brought about which are expected to be effective in the future, those should definitely be considered in conjunction with the historical data to arrive at the attrition rate. Attrition rate can also be applied on revenue or on a per customer basis. So how you look at attrition as a professional depends upon how the customer, how the intangible asset owner is tracking that attrition rate, whether he's looking at the attrition on an overall basis, where loss of revenue is a percentage of the total revenue, or he's looking at it as a loss in number of customers, or sometimes it could be a mix of both. So these are the important aspects to consider when looking at attrition rate, particularly for valuation of customer relationships. This is slightly tricky, so please feel free to put your questions to the moderator and I will be happy to take this in the Q&A session, because this is one of the areas where I have encountered most Q&A from CAs and from valuation professionals in the sessions which I have spoken at. The next important consideration is the tax amortization benefit. Now, again, this is a tricky concept, and tax amortization benefit, if I can explain it extremely simply, it is the tax shield arising to the owner of the intangible asset. For example, let's look at the case of a car and the case of a brand. A business has bought a car and has capitalized it, and it is claiming depreciation under the income tax regulations. If 10 lakhs was paid for the car, the depreciation is being computed, the tax depreciation benefit is on those 10 lakhs for which the tax benefit will be available. But when we look at the brand, we have considered incremental cash flows arising to the entity by using that brand to value the brand. But the ownership of the brand results in certain tax benefits, which we have not considered. In case of the car, if we were to say that out of the 10 lakhs, 3 lakhs is the tax benefit, that leaves 7 lakhs as the amount arising or giving benefit from the usage of the car. On the similar footing, the 7 which I speak in case of the car, the 7 lakhs, the cash flows, the present value of the cash flows arising from the usage of the brand is equivalent to the inherent benefit of owning that asset. But there is a tax break available, and hence the present value so arrived at for the brand has to be grossed up for the tax benefit, the tax amortization benefit. That is the tab or the tax shield which I'm speaking about. Intangible assets get tax shield for their amortization, which effectively increases the value of the intangible asset depending upon its nature and purpose of valuation. The deductibility of amortization is dependent on two aspects: the corporate income of the entity and the tax regulations of the country where the asset is located. This is very important to understand. If our brand, say the brand which we are valuing, is operating across the globe but is predominantly located in India, it's an Indian asset, irrespective of the geography from where it is deriving economic benefits, sales or cost savings, right? So if the asset is located in India, it is an Indian asset on which the tax amortization rules of Indian income tax regulations will apply. This is very important to establish because particularly in cross-border transactions or in multinational organizations and operations where the asset may generate revenues or cost savings from numerous jurisdictions, it becomes important to establish where the asset is located so that the tab can be appropriately computed. The tax rate commensurate with that used for corporate income tax purposes should be used. The period of amortization to be considered is as per the law, and the method to be adopted is also as prescribed by the law of the land. For example, in the Indian context, we use the written down value method and amortize the asset considering a 25% discount depreciation rate. Whereas in the US, it is a straight line 15-year amortization. So the period of amortization and the method which is considered should be commensurate with the laws of the land, wherever the asset is located. And the discount rate used to determine the present value of the tax amortization benefit has to be that is being used to value the intangible asset. Now, from an Indian context, typically we have seen tax amortization benefits being implemented in valuing patents, technology, uh, customer relationships is a gray area, trademark, know-how, even goodwill for that fact. So you have to be very careful about what you are applying the tax amortization benefit to arrive at the final value, because in some cases if it's a gray area or if the law of the land doesn't specifically permit it, uh, a lot of times under tax regulations or assessments it may get disallowed. So this has a real cash flow implication and hence becomes very important. With this, we move on to the specific methods in income approach used to value intangible assets, starting with the multi-period excess earnings method. Over here, I will invite Jay to take over the next few slides from me.
Sure, thanks. Am I audible?
Yes, Jay, if you can speak a little louder, please.
Sure. So the first method under the income approach being the most commonly used method, and then as we commonly call it the meme method. The main focus or the fundamental rationale driving this meme method is, in case if you're valuing an intangible using an income approach, the projections which you have for the specific intangible that you're valuing for economic life of intangible, which Apeksha discussed earlier, that the cash flows attributable to the intangible and all the other assets which are being put to use along with that intangibles. So once you start with that cash flows attributable to that intangibles, you remove the cash flow which is attributable to other tangible and intangible assets used for generating the cash flows or for generating the profit. And then from the overall cash flows, you reduce this cash flows which is attributable to other assets, which is commonly called as contributory asset charges. The remainder of cash flows, which is only the value of your intangible assets which you are focusing on, is the value of the intangible assets. You PV that cash flows year on year, and you get the value of that intangible asset under meme. In the step which I said earlier, contributory asset charges. What does contributory asset charges mean? Contributory assets are assets that are used along with the subject intangible assets for realizing prospective cash flows to be generated by the subject intangible assets. So, in the example, say a manufacturing firm, I am valuing a customer relationship, and there are cash flows from customer relationship which we have year on year. Now, this cash flows from customer relationship are not only because of the customer relationship only being there, that are also because of fixed assets being put to use in that manufacturing entity, the working capital being put to use, and apart from that, the smaller intangibles as an assembled workforce or any other intangibles which are used along with this intangible to generate the overall cash flows. So when we are valuing customer relationship under meme, the value or the cash flows from the business year on year is not only attributable to customer relationship, it is attributable to all the assets put together. And hence, from the overall cash flows, you try deducting the cash flows attributable to fixed assets, to working capital, to assembled workforce, to any other intangible assets, and the remainder is the cash flow which is attributable to customer relationship. This is the main thesis or the main rationale of how a meme method is applied. A meme method is the primary and the most commonly adopted method, and it's generally used to value the main and the primary intangible assets of any business. I'll move on to the next slide where I will explain you in detail each of the steps that we usually follow while doing a meme approach. Next slide, please. So the first and the foremost step is consider the revenue associated with the subject intangible assets and the related contributory assets over the economic useful life of the subject intangible assets. So first you start with the overall revenue or the overall business projections. You have the revenue from the overall business projections, and from there you identify the revenue associated with the subject intangible assets. I'll give an example again of customer relationship, and let me pick an example which Apeksha said earlier, that we were doing a government business, or we are valuing an intangible where the business was they used to help government clients in processing visas. So we had a 20-year projections from the client, and from the overall business projections, ideally the accounting principle requires us to value existing customer relationship. So from the overall business projections, at a given point of time, as at the valuation date, they had 50 contracts with government bodies across the globe, and the projections were given to us in such a way that the 50 contracts will generate X revenues. There will be new contracts which this entity would kind of win, and then A plus B was the overall business projections or the overall revenue of the business. However, when you are valuing an existing customer relationship, we would take only the revenue associated with the current existing customer relationship. And the current existing customer relationship in the given example is only the existing 50 government bodies which they work with. So identifying the right set of revenue associated with the subject intangible assets is very important. Again, in any manufacturing firm, for example, when we are given projections are generally driven in a way where you have business growing not only from an existing clients but new clients also. So when we are valuing an existing customer relationship, you first kind of bifurcate the revenues or come to a revenue which is attributable to only the existing customer relationship. So from the overall revenue, you come to a revenue attributable to the specific intangible asset. From there on, the process is straightforward, where you consider the cost. Once you arrive at the revenue attributable to the intangible assets, what are the costs that you incur to earn that revenue? So normally the cost of goods sold, in case if it's a manufacturing firm, the variable cost, the operating cost, you reduce the cost one by one and you come to a profit attributable to the intangible assets. I'll also like to connect one point which Apeksha discussed earlier in terms of calculating attrition rate. So, in the given example earlier, say there are revenue from the existing customers. The revenue from existing customers, there would also be attrition and churn year on year. So, in case if there are 50 government contracts, or they say in the manufacturing firm there are 50 clients, based on the historical attrition analysis, you come to a conclusion that okay, the attrition rate every year is 5%. So there, out of the existing customers, you lose out 5% of the customers every year. So the revenue which you calculate for valuing the intangibles year on year should also be adjusted for the attrition rate analysis which you would have performed earlier. And then after the adjustment of the attrition rate, you come to a net revenue attributable to intangible assets after attrition rate year on year. Then you adjust the cost, which is the cost such as cost of goods sold or the variable cost, and come to profit attributable to the intangible assets. When certain nuances, like when you're valuing a customer relationship or a distribution network, there are certain costs which are incurred specifically to win new customers. So you should take into consideration that you should not directly take the overall business net profit margin or the overall business EBITDA margin while arriving at the profit attributable to the existing customer relationship. You should also factor in adjustments such as uh, marketing and branding activities which are generally done for winning new customers. So once you have the cash flows attributable or the profit attributable to that intangible, then from there on you identify the contributory asset charges which we discussed earlier. So the contributory asset charges are in the form of fixed assets, working capital, assembled workforce, and other identified intangible assets over and above the subject intangibles being valued. How do we calculate the contributory asset charges? So again, giving you an example of the manufacturing entity which we discussed, that when you are valuing a customer relationship of a manufacturing entity, not only the customer relationship is generating the cash flow, but the overall fixed assets, the plant and machinery being put to use, the land being put to use, if there is any, the working capital and assembled workforce being put to use, all of this together are generating profits for the business. And hence you identify each of these contributory assets and calculate an appropriate contributory asset charges to deduct from the profit attributable to the overall intangibles, and then deduct that contributory asset charges, and the resultant figure will be only the net value attributable or the cash flows attributable only to your intangible assets. The way we generally calculate contributory asset charges is, we look at the opening block of fixed assets, we look at year on year addition. So we have a fixed asset schedule year on year, and then based on the fixed asset schedule year on year, we calculate the expected return on that fixed assets. And expected return on fixed assets for any market participant view would be, any fixed assets would be say funded by generally a 60-70% debt and a 25-30% equity. What would be the weighted average expected return on this fixed asset is a percentage that you apply on the closing balance of fixed assets year on year, and the resultant number is nothing but the contributory asset charges. Say for example, you have a fixed assets of 500 crores and the expected return on the fixed assets is 10%. So on a 500 crores of fixed assets, a 10% return will come to a number of 50 crores. That means the out of the overall cash flows or profit attributable to the intangible, 50 crores itself is contributed by the fixed assets. Similar calculations are done for working capital and assembled workforce. And from that overall cash flows attributable to all intangibles, you deduct this contributory asset charges to come to the value attributable or the cash flows attributable only to the intangibles. Once you have that cash flows attributable only to that intangibles, the rest of the steps are very simple. You apply the tax rate, uh, which is applicable on the business from a market participant. You again over here, you should be mindful of certain nuances such as use the tax rate which is specific to the location where the intangibles is situated or registered. Even in case if there are brought forward losses in the business, generally from an intangible specific perspective, we take a market participant view and say that in case if I have to sell only a specific intangible, I do get tax benefit or the cash flows will be subject to tax deduction, and you apply an after tax rate of you apply a after tax you apply a tax rate and come to an after tax cash flow. Once you arrive at the after-tax cash flows, you use a discount rate which is commensurate with the intangibles being valued, and PV the cash flows to come to a value of the intangible. On that overall value of that intangible, you add the tax amortization benefit, which my colleague Apeksha discussed earlier, to come to an overall value of intangible assets using the meme approach. Uh, Next slide, please. So this is a mathematical representation of the steps which I discussed earlier. Say, for example, we are valuing customer relationship, and the life of the customer relationship in the given case is 3 years. We first come to cash flows associated with the subject intangible assets, which is 10,000, 20,000, 30,000 in year 1, 2, and 3. The attrition rate based on the calculation is 10%. So 10% on the revenue year on year, you deduct and you come to net revenue after attrition. Then you arrive at a profitability factor of 20%. So the earnings before interest and tax as a percentage of net revenue after attrition is 20%. Again, while you use this 20%, you should look at the overall profit of the entire business. You should look at cost specific to uh, earning or getting new customers and come to an adjusted margins specifically attributable only to this intangibles. Once you arrive and imply this 20%, you also adjust the 30% tax rate which is applicable and come to a profit after tax which is attributable to all the intangibles. Then you deduct the contributory asset charges for using the other assets. In this example, the number is only 5%. And after you adjust that contributory asset charges, the net cash flows which you see in the last row are the cash flows attributable only to the intangible assets or the value or the customer relationship that we are valuing. So the net cash flows year on year, we have 11972394 or 3591. This is the cash flows attributable only to customer relationship. Next slide, please. Once you have that, you discount the customer relationship cash flows using a discount factor. Uh, Generally, as Apeksha said earlier, the riskiness of intangible assets is generally higher than an overall business. So once you have a WACC or once you have an IRR calculated for the business, you should consider a discount rate which is generally higher than the WACC and IRR, because the risk of an intangible assets in its identical or a separable intangible asset is relatively higher than the rest of the business. After coming to a PV of cash flows, you add the tax amortization benefit, and then the overall value, which is the A plus B, is the fair value of intangible assets of customer relationship. This is how a meme method is applied, and I'll just take a pause here if Apeksha wants to share certain feedbacks or certain nuances while applying meme.
Jay, I think you covered it well. Over here, nothing specific to add. Only that this is the most important method to value intangible assets. So if the audience has any questions, please feel free to ask them to the moderator and we will try and answer them at the end of the session.
Sure. So I will move on to the next method, which is the second most commonly used method while valuing intangibles under the income approach, which is the relief from royalty method, which is commonly known as the RFR method. The main premise of the RFR method is, say for example, you own a brand, vis-a-vis you not owning that brand, and you would have to license that brand from someone else. Uh, what would be the kind of license fees that you would have paid, or the hypothetical royalty payment that you would have paid to any entity or business who owns the brand? So the potential hypothetical royalty payment that are saved because as a business the brand is owned by that entity, the cash flows which are saved year on year, you PV that cash flows, and that is the value of the intangibles under the RFR method. So the thesis is well explained in the slide as well. The value of an intangible is derived on the basis of value of hypothetical royalty payment that has been saved or that would be saved through owning the asset instead of licensing the asset from a third party. This can also be viewed as the cash flows received by the owner through licensing the intangible to third party. Typical cash flow that is saved by someone who owns the asset is calculated based on royalty rates, which are generally prevalent in the market or similar comparable transaction, or profit split method in terms of the royalty rates are not available, and say that cash flows are 20, you come to a number, say 20-30% are attributable to that specific intangible because you're owning that intangibles, and the balance 80 is for rest of the assets being put to use. So from 100 you come to the 20 which you have saved specifically because owning that intangible. Both how the royalty rate and profit split method are calculated, I will explain it in the next slides. The steps for coming to a value of intangibles using the relief from royalty method. The first step is consider the projections associated with the intangible assets being valued for the life of the subject intangible assets. Over here, in the meme method, which I explained earlier, while we are taking an example of customer relationship while valuing meme, we did adjustments such as only looking at existing customers, doing attrition rate analysis, and then coming to revenue specific to that intangible, being the customer relationship under the meme method. When I come to relief from royalty method, let me give you an example of brand. Say a business has a particular brand and the entire business is driven through that brand. So over here, even though there are existing 50 customers, but all the future revenue, be it from existing customers or be it from new customers, that entire revenue is earned through usage of that brand name. So say for example, I give you an example of Colgate. Colgate has existing distributors or existing customers, and they will also potentially sell to new customers. The entire revenue from the business of Colgate in the current case, uh, the entire business will be sold through the usage of Colgate brand or the HUL brand. So over here, you use not only the existing customers, but the entire revenues which are flowing year on year from that usage of brand. Once you have that revenue, you apply a appropriate royalty rate for the subject intangible assets. What is a royalty rate? Royalty rate is a rate which, in case if someone who is owning that asset is licensing to any third party, the general market parlance or the commercial way that the owner of the assets license it to a third party is using a royalty. And when I say royalty, there is a percentage of revenue, which is a 2%, 5%, 10%, whatever that percentage agreement is. 5% of the overall revenue which is earned is given to the owner who owns the brand or the owner of the licensing agreement. So that 5% is nothing but a royalty rate. So once you arrive at the overall projections year on year, you apply that royalty rate, which is a, which is an input or which is an assumption. How do we calculate that royalty rate is also something which I would touch upon. Once you apply the royalty rate on the revenue, you come to cash flows which are or the revenue which is or the cash flows which are saved because of you owning that asset, and that is the cash flow specific to that intangibles being valued. From that you factor adjustments like maintenance or marketing. Since you own the brand, you should also maintain the brand, such as marketing and maintenance strategies, and you determine that expenses and come to an adjusted royalty savings which is there year on year because of you owning that brand. Once you have that tax flows, again similar to meme, you adjust the tax rate, you come to an after tax cash flows applicable to that intangibles, apply a discount rate year on year, and calculate the present value of the savings associated with the ownership of intangible assets. The total of the present value will be the value of intangible assets. On that, you add the tax amortization benefit, and you come to an overall value of intangible assets using the RFR approach. The point earlier which I wanted to make in terms of how do you calculate royalty rate. There are in India generally you don't get it very commonly, or you can just can't find that information, but there are databases like royalty source and merger market which we as valuation practitioners generally use. Uh, in terms of we being able to use that software, all of these are paid softwares, but you kind of try to search the transactions or the nature of the business for which you're trying to come to a royalty rate, and the software gives you similar transactions Say I'm trying to value something like a Colgate brand, and I search for FMCG transactions in the consumer space in that database, and it will give me a list of transactions along with the royalty rates which were applicable in that kind of transactions, which then can be used as a benchmark when we are valuing our intangible assets. Uh, Mathematical represent. Sorry.
Jay, just to add to what you said over here, see, when we are trying to determine the royalty rate to apply to the subject intangible, the process is very similar to determining peer companies in case of business valuation. The factors to be considered over there in a in a business valuation where we are trying to identify comparable companies, factors such as size, geographical market, products and services being offered, any differentiation in the products and services or any variants, other factors like whether it is purely export or entirely domestic, uh, large the nature of industry which is being serviced. These factors are also applicable when one determines the royalty rate being determined to value the intangible asset. If your brand, Jay spoke about Colgate, say if Colgate is to be valued and it is a FMCG product, particularly in oral hygiene, the endeavor should be to use a database to give you comparable royalty arrangements in the same industry, preferably in the same industry, uh, same geography, sorry, and also maybe more recent transactions than old ones. Now, the process, like I said, is very similar to identifying peer companies. In the Indian context, you may not find this data point very easily available. Apart from paid databases, looking at annual reports of comparable companies which have been adopted for WAC computation may also be a good idea. And a secondary research in the public domain on the internet can also help. Um, but let that not limit the adoption of royalty relief, the relief from royalty method, because the paid databases, even if they give you a geographically diverse output, may eventually be more palatable than relying only on a set of handful of transactions purely from an Indian context. So as a practitioner, as a valuer, it is better to have more data points than less, because then lesser data points limits your analysis. Over to you, Jen. We will go to the
Thank.
mathematical derivation.
So yeah, the previous slide spoke about the steps, and similar to meme, we also have a graphical or a mathematical representation of how we come to a value of intangible using an RFR approach. Again, similarly, cash flows associated with the subject intangible, we have 3 years, which is 10,000, 20,000, 30,000. And based on the research and the databases that we could find in the given case, the royalty rate is 1%. So on the revenue of 10,000, 20,000, and 30,000 year on year, we apply that 1% royalty rate to come to a pre-tax royalty income or pre-tax royalty cash flow of 100, 200, and 300. This is the cash flow which the owner of intangible has saved because of they using that or they owning that intangible. You adjust the tax rate of 30% in the given case, it was an Indian entity. So 30, 60, 90 on the pre-tax royalty income, you come to a profit after tax. Over here, there is no adjustment of contributory asset charges similar to RFR because the 1% that you have researched and applied on the revenue is that 1% is specifically only for owning that intangible. This is so hence there is no adjustment of contributory asset charges required in the RFR approach. From the profit after tax, you come to a discounting factor adjustment. You PV the cash flows, add the tax amortization benefits similar to meme, and you come to a fair value of intangibles using the RFR approach. The third method, which is after the meme and RFR method, is the with and without method. This method calculates the value of income differential an asset will generate or protect relative to its absence. So, a with scenario, a business considers the economic benefits of an intangible subject intangible assets, and in without scenario, business does not use the subject intangible assets, other factors remaining the same. Let me give you an example of non-compete over here, and the with and without method is generally used to value non-compete. In typical transaction and buyout arrangement, any acquirer generally has a non-compete agreement with a previous promoter selling the business, that they will not get into a similar business for the next 3 years or the next 5 years. So this is where the non-compete comes into place, and non-compete is how is valued with the with and without method. So in the given case of valuing non-compete, acquirer has the overall business projection, assuming that that previous acquirer or the previous seller or the promoter will not do this business. In case if that non-compete would not be there, after selling that business to the acquirer, the promoter or seller will again come into, or they again can do a similar business and try to poach the customers from the business which they have sold earlier. In case if they do this, the acquiring entity has a loss of customers or a loss of sales because of they not being able to have that non-compete in the agreement. Hence, generally the non-compete agreements are calculated or done calculated with a with and without method. And the premise is, in case if you have that intangibles, X is a cash flow. In case if you don't have that intangible, what would have been the cash flow? The differential between that X and Y will be the cash flow attributable to that specific intangible assets with a with and without method. I'll move on to the next slide. It's similar to what we discussed, the difference between business values obtained under each scenario. So scenario X is with an intangible, like a non-compete, and scenario Y is without an intangible, and the difference between X and Y is the difference. And you present value that difference based on the discount rate to calculate the value of subject intangible assets. The next slide has each steps of how we get into it. Consider cash flows in the with scenario, that is projections of revenue, expenses, capital expenditure, and working capital requirements of the business, including the subject intangibles. The second scenario, which is the step 2, is consider the cash flows in the without scenario, that is projections of revenue, expense, capital expenditure, and working capital requirements of the business, excluding the subject intangible assets. One critical point to note over here is in step 1 and 2, while you determine the cash flows in a with and in step 2 in a without scenario, the the premise is all other things remain constant. Even in case where you have a set of projections and you are considering a without scenario, and you come to revenue of a without scenario, the percentage of expenses or the capex requirement or the working capital requirement of the business remains the same, like a with and without, like a with scenario. Calculate the step 3 is calculate the differential cash flows on a pre-tax basis. The rest of the steps are commonly or are same as what we did in the meme and RFR. You apply the relevant tax rate and compute after tax cash flows. Calculate the present value of cash flows using an appropriate discount rate. PV that cash flows and add a tax amortization benefit if applicable and appropriate. That will have the value of intangibles under with and without method. Then, as an additional steps, there can also be probability weighted adjustments can be which can be done. Uh, this probability weighted adjustments are more in terms of commercial and a rational use of valuing that intangibles in a with and without method. And in the example which I gave you earlier, the promoter sold of the business to the acquirer. The promoter, the agreement did not have non-compete. Now, now say for a in the current case, the promoter is 80-year-old. Uh, he is retired, and in any which case having a non-compete or having not having a non-compete, the probability of he now going into market at this age and doing that business all again will be very low. So even in case if you are valuing a with and without method, the probability weighted adjustment should also be considered to factor all the commercial rationale and the logical reasoning if required when you do a value with a with and without method. And the difference in value between the two scenario after the probability weighted adjustments is the value of that intangibles under a with and without method. There is a again a mathematical representation of a with and without method in the next slide.
Jay, over here, one thing which I would like to add. So, you spoke about the example of an 80-year-old gentleman who may have signed a non compete, but the probability of him actually competing is very low. Similarly, let's consider another example where, say, the non compete has a clause of 5 years, but the erstwhile seller of the business, I mean, the party which has sold the business to the acquirer, has entered into an employment contract or has an earnout associated with the acquisition and continues to remain with the business which has been acquired by the acquirer for a 4-year period. In that case, after the fourth year period, so there is an overlap between the earnout period of 4 years and non-compete period of 5 years for the first 4 years. And in such a situation where the erstwhile seller has been with the acquired business under the new management for 4 years, may not have a very large incentive to really get into a business which he has actively sold between the fourth and the fifth year. In that situation also, the probability of him competing and hence the valuation of the non-compete may be very low. So between these two examples, what Jay and I are trying to explain is that valuation of non-compete is extremely situational, and the cash flows and the period over which it is considered should be evaluated very, very carefully, considering the facts and circumstances and the most probable outcome considering all information in hand. Jay, over to you for the illustration.
So over here, before we move on to the mathematical table, which will be in the next slide, this is the example which we want to display. A non-compete agreement has been acquired in a business combination. Under the terms of contract, the head of sales of the acquired business is prohibited from taking up a similar position at a competitor for a time period of 3 years. It is estimated that in the absence of non-compete agreement, the former employee would find a similar position and pose a threat to the acquired business without any time lag and with full instant effect. This would result into erosion of sales with existing customers as well as additional marketing costs to maintain the current customer base. The economic life of non-compete agreement is estimated to be 3 years. Management estimates a 25% dip in sales and an additional marketing expenses of 15% in event of competition. In the given case, how do you value the non-compete agreement in this case? Next slide, please. So you start with the revenue, year 1 to 3. The life of the non-compete is 3 years, as mentioned in the previous slide. Again, as explained in the previous slide, in case if the head of sales moves out to a competitor, immediately and with instant effect, he is being able to take 25% of the business to the competitor. So the effect of competition on revenue is 25%. That adjustment of 25% on the revenue will be a revenue without non-compete agreement. So the earlier revenue of 10,000, 20 and 30 is with non-compete agreement. The 7,500, 15,000 and 22,500 is without non-compete. Then we move on to the cost. Marketing cost as a percentage of revenue is 20%, which is 2,000, 4,000, 6,000. In case if the non-compete was not there, the erstwhile promoter or the erstwhile acquirer will have to incur 15% additional marketing cost. That was also there in the previous slide. An increase in 15% on 2,000, which will be 300, on 4,000, which will be 600. Similarly for year 3. So marketing cost as a percentage of revenue, which is 2,000, 4,000 and 6,000 with a non-compete. Without a non-compete, the marketing cost would have been 2,300, 4,600 and 6,900. Other expenses as a percentage of revenue are 20%. So year on year, you have other expenses, which is 2,000, 4,000, 6,000. These expenses are a nature of fixed expenses. They remain as is in a with and a without scenario. And then adjusting this A minus B minus C, where A is the revenue, B is the marketing cost, and C is the other expenses, you come to pre-tax cash flows with a non-compete, which is 6,000, and pre-tax cash flows without a non-compete, which is 3,200. 6,000 is 10,000. 10,000 minus 2,000 of marketing cost minus 2,000 of other expenses, and 3,200 is 7,500 of revenue without a non-compete, less 2,300 of marketing cost without a non-compete, less 2,000 of other expenses, which adjusted comes to 3,200. You come to similar numbers for year 2 and year 3, and you have cash flows with non-compete and cash flows without non-compete for all the 3 years. Whatever the differential cash flows are, 6,000 minus 3,200, which is 2,800, is the cash flow attributable to the non-compete being in place. So you come to a number year on year, you adjust the tax of 30%, you come to a post-tax cash flows, adjust PV the cash flows using a discount rate. Whatever is the overall PV of cash flows is the present value of intangibles. You add the tax amortization benefit and then come to a fair value of intangible assets using a with and a without method. So these are the three methods which are generally used in the income approach. And as said earlier, the income approach is where the most commonly adopted methods are the meme, the with and without, the RFR approach. And generally, as an overall concept checker or on an overall level, in case of the best practices that we see based on experience, uh, assets such as trademarks, brands are valued under RFR or a meme method. Uh, Internet domain and websites are generally valued using guideline transaction method. Non-compete is using with and without method. Customer relationship distribution networks are using multi-period excess earning methods. Software and assembled workforce are valued using replacement cost method. Technology, which is used for any businesses, that can be valued using an RFR method or a meme method. So these are the commonly adopted list of intangibles and the manner in which this can be valued.
Right. With this, we come to an end of our presentation and we are open to questions. In the presentation, we have endeavored to set out all critical aspects which we typically encounter in intangible asset valuations, particularly around adoption of the multiple excess earnings method like the discount rate, the attrition rate, the adoption of tab. And of course, it is a very wide space and it's an evolving uh, field also. So if there are any new developments which come about, we try and adopt that. uh, this is slightly evolving, I would say, but we've tried to cover what we generally come across in valuation of intangible assets, and I hope you have found it useful. Now over to Anisa ji for any questions which the audience may have. Anisa ji, you're on mute. Anisa ji, we're not able to hear you.
Am I audible now, madam?
Yes.
Okay, sorry. Yeah. So, madam, we have received many questions, so I'll be just going through few of them. Okay. The first question is, how would you value non-business generating non-revenue generating business?
Anisa ji, this question, so non-revenue generating business, are we talking about startup valuations or are we talking about a product?
Actually, the participant has not mentioned anything about that in the question.
Okay, so if I were looking at a non-revenue generating business, if it is non-revenue generating, then there are 2 or 3 possibilities, that either it is a stressed asset where it has stopped operations, or is it an asset which has not yet been monetized and hence the business is not able to generate revenues. So these are 2 different situations which may be looked at very differently. If it's a stressed asset which is which has stopped operations because of financial stress or any other kind of hindrance to its operation. And over there, it is difficult to predict any sort of monetization from an earnings capacity perspective. Then a cost approach using the liquidation method may be adopted, where you consider fair value of all assets and liabilities on the books as at a reporting date and consider the valuation. In the second instance, if it is a business which has an asset which has not yet been monetized, say a pre-revenue earning startup, over there are various different methods of startup valuation, but one can also consider discounted cash flows, where one takes cognizance of the revenues arising in the future, the profitability, and also the costs required to be incurred from the non-monetization or a non-market, how do I say, a non-revenue generating stage to a revenue generating stage, where commercial operations uh, can be expected to commence, and consider all of those in the valuation. But then if it's a startup, there are numerous other methods also which can be adopted.
Okay, thank you, ma'am. How to do valuation of software in CIRP not doing business for the past 3 years? For example, if the book value was 50 lakhs and written down value is 3 lakhs.
So this is the valuation of the software.
In case of CIRP, yeah, resolution process.
Right, which is in insolvency.
Right.
So, like I said, in that case, see, there are two situations which we typically encounter. One is the valuation on an as is where is basis, which is the liquidation value, where you consider what would this sale of this asset fetch in the market. The other is a fair value, where one tries to see what are the costs required to turn around the business and bring it to a stage where it can again operate, and then value it. But over here, the specific question is on software and not on the business. So
yes.
if it is only the software, in that case, and I'm assuming software over here will be the primary asset. Right? In the liquidation scenario, you will consider it at cost, but if you're looking at a fair value, in fair value, it will be a future cash looking approach.
Okay.
But we come down to the very basic fact that if the business has no value, the business is not operating, the underlying software, which is the primary asset, cannot also be attributed any value till certain further costs are incurred to make it operational.
Okay. Thank you, ma'am. The next question is for franchises or brand valuations. How can value it? RLF is generally considered.
So in that case, the approach to be considered is income approach. You can use a multi-period excess earnings method for franchisee and for brand. And for brand particularly, you can use the relief from royalty method. In the, say, I will give you an example in the FMCG space, where brand is the driving intangible underlying, and the association of distributors or any marketing arrangement is also linked to the strength of the brand which it enjoys in the market. In that case, that will be the most important, and either an RFR or a meme can be considered. But in case of franchisee, I would think the multiple excess earnings method is the most relevant method to be considered for valuation.
Okay, the next question is, who is qualified to value intangible assets in case of own developed asset?
In case of own developed assets, okay. So if the asset has been developed in-house, it is not an acquired asset, our accounting standards do not permit recognition of such assets. In that situation, the only reason why an owner or the owner of the self-developed asset would want to value it is for financing purposes or for a transaction. If it's a transaction or for funding purposes, then any CA or any registered valuer can be appointed to carry out a valuation of that.
Okay. Next one is, what are the sources of data through which these valuation can be determined for acquired assets?
Jay, would you want to answer that?
Pardon me?
I'm requesting if Jay would want to answer that.
Okay.
I think he has some technical issue. I will take it up. So the various sources which are used to value intangible assets. See, I will say that one clear understanding of the business and the industry in which the asset operates. So any data, any industry reports which help you identify key business drivers will also help you identify what are the key intangible assets.
Right.
That is one. Second is databases like Bloomberg, Capital IQ, Capline, and even BSc, NSC websites provide enough data for us to be able to determine WAC and other valuation related aspects. Then third important becomes the company's own information, which will help you, which will give the practitioner a deep dive into certain factors like attrition, like applicable tax rates, understanding the jurisdiction in which the company operates from an income tax perspective is also important. And then there are certain databases like royalty source, royalty stat, markables, which are paid data sources and help identify parameters like royalty rate, life of trademarks, and things like that.
Next question is, one of my client, just 1 second, madam. One of my client who is startup in hospital services want valuation of intangible assets being technical platform contact with hospitals and insurance companies. My question is, he want the valuations to arrive to be recorded in balance sheet. I think we are not clear with this, what exactly the participant is asking for, right? Okay, maybe so
we will retype the question.
Yeah, we can request him to retype the question, right? The next one is, when do we capitalize the intangible asset in case of own developed computer algorithm by a software engineer that is being tested for algo trading and working successfully?
In that case, Anisa ji, I don't think our accounting standards permit recognition of self-generated assets, right?
Right.
Until unless it is acquired by somebody.
Own developed computers, right. Can we revalue an intangible asset that has been fully written off but still used in business for getting revenue?
So it depends. Say one has to. So if it is an acquired intangible, it has to undergo impairment assessment every year at each reporting date.
Right.
At that point in time, it is assessed. If it is an indefinite life, infinitely lived intangible, then it necessarily has to be tested for impairment. So if the asset has been written down and is continuing to be used in the business, then I would say that in the first instance, whether it was valued appropriately, where the economic life was considered in accordance with the facts of the matter. But I have not come across an instance where there's a revaluation of intangible being considered. Like the upside is usually considered for more tangible assets like land or maybe building. But I have not come across a situation where intangible asset is being revalued.
Okay, but impairment, it is being done every year.
Impairment, yes.
Impairment of assets, yes.
So infinitely lived intangibles have to be tested for impairment every year. If it is an asset which has been written off and is still being used in the business, then maybe the assessment of economic life for that asset was not appropriate.
The next question is, can expenses incurred like mobilization, license fees, salaries, etc. for bringing an operating lease equipment, aircraft ready to fly, can it be considered as intangible? I feel it should not be, but would like to know the expert opinion.
No, it cannot be because it is associated with a tangible asset and it is being spent to ready the tangible asset to put it to use.
Next one is, how are the weights computed in VARA analysis?
It is the value weight. So it is slightly circular exercise where you say determine the discount rate to be say 10%, and you see the value which is arising and what is the value weight which contributes to the result to the value. So it is slightly circular. 10% goes in determining the value which goes to determine the weight that 10% has in the total.
Okay.
So it is a slightly circular exercise which one needs to do.
Okay. Next one is whether valuation of intangible assets could be carried out by registered valuer, securities and intangible assets class, or by plan. So it should be securities and financial assets. Right?
Yes.
Yes. In case of goodwill under income tax, depreciation is not allowed as deduction. Will we still be calculating tab on it?
Goodwill, there is no, so like I explained, goodwill is the residual number which remains. So let me take an example. If the consideration paid is say 100 crores and the assets identifiable are land and building, plant and machinery, total having a value of 50 crores, say a brand of 20 crores and technology of 10 crores. That leaves us with 50 plus 20, 10, 80. So 20 is the remaining amount which will be the residual goodwill. So in case of goodwill, it is just a balancing number, nothing else. There is no tab computation or anything like that on goodwill, because when you would be valuing brand, which is permitted as a amortizable intangible under the Income Tax Act, and so is a technology, when valuing those, you've already considered the tax benefit.
Right.
So whatever remains, it comes into goodwill, which then becomes deductible or non-deductible depending upon the geography in which you are operating.
Right. Next one is value of customer relationships same as value of order book, or it is different?
So two approaches. It depends upon what is the duration of your order backlog. It may be it can be anywhere between 1 month to 18 months or 2 years, and thereafter there may be a contract, and post the contract period there may be a customer relationship. So these are different stages of your customer relationship itself. The first part is contracted, but even within a contract there may be a committed scope of work and the balance contract. So the committed scope of work which you have orders for becomes your order backlog. The remaining contracted period amount becomes your customer contract. And after the contract is over, if you still have a relationship going with the client, even if not contracted, becomes customer relationship. So these are terminologies used in the life cycle of a customer relationship. And there cannot be an overlap between the revenues which are considered for order backlog and for customer relationship. Sometimes the relationship is so short that the acquirer may not want to get into the hassle of recording order backlog and contract and relationship separately, and hence it may be merged together, but there cannot be an overlap between the two. You either record it as a total, or if you're bifurcating, there are distinct cash flows for order backlog and thereafter it is relationship.
Okay. Next one is how to allocate contribution to several intangibles while using multi-period excess earning methods.
Sorry, can that be repeated?
How to allocate contribution to several intangibles while using multi-period excess earning method.
So this is about contributory asset charge. So say I will take the most simplest of examples. We spoke about valuing say the brand using the multiple excess earnings method. In that case, that brand has come about because there is plant and machinery, land and building, a return expectation on the land and building. If you consider land and building multiplied by the return expectation, that becomes an allocation from the profitability to land and building. For say technology, we've used a 2% of revenues as the royalty rate. That 2% of the profitability is attributable to technology, and whatever balance remains is the profit attributable to the brand which is being valued.
The next one is at times non-compete fee is paid to previous year over period of non-compete. How is that factored in with or without method?
So the actual payment of non-compete is not factored into the valuation. Okay, so let's take a step back. The reason we will value a non-compete is because the value is not described. The quantum of consideration for non-compete is not mentioned in the agreement, in the transaction document. So if two parties have one has decided to sell the business and the other has decided to acquire the business, the agreement may not mention the amount being paid for non-compete. It may have an overall consideration of say 100 crores. But if the agreement mentions that out of that 100 crores, 5 crores is for non-compete, then a valuation is not required at all. You just pay that 5 crores.
Okay.
And that becomes the value of your non-compete. The reason we get into valuing a non-compete is because it is not the consideration is not defined in the agreement.
Right.
And when you value the non-compete, then you will not explicitly consider a payment for it because that is what you're valuing.
Okay. The next question is, practically in RFR method, since data point for royalty rate is not easily determinable, do companies tweak with these values? For example, using higher royalty rate to reach to a lesser income, to attract lesser tax, and what checks are imposed by government to avoid such tweaks?
So, determination of royalty rate from a transaction perspective is a commercial call between two individual parties. So that will be at arm's length. But if it is not between unrelated parties, but is between two associates or two related parties, then we have the Transfer Pricing Act regulations which mandate arm's length determination. Now, this is practical application of royalty for transaction purposes. But purely from a financial reporting perspective, when you are determining the royalty rate for financial reporting valuations, I will not say the data points are not available. These are paid databases which the valuers can definitely, go into the public domain, pay for and acquire. The management in that case, while of course a discussion with management during the valuation process is very important, but the management's input can be considered but cannot be the concluding factor for determining the royalty rate in the valuation process.
Right. So the next question is, we can take one more question.
Sure.
Can a liquor license issued in favor of a bar and restaurant be considered as an intangible asset and valued using the replacement cost method? Please note that the license has to be renewed each year at the rate determined by the respective state beverage corporation.
No, I don't think this has a material value because it is easily obtainable after meeting certain conditions set out by the regulator. And since it is to be renewed every year, the renewal cost may also not be very high. So from that perspective, I don't think it needs to be valued separately.
Right. So this we come to end of the question and answer sessions. Madam, it was an excellent delivery by you and your co-speaker CAJ, and I am sure that it has benefit to a great extent to all our participants, and they have you have very well explained the different types of intangible assets, various methods applicable to the intangible assets, various parameters which are to be used during the valuation process. And you have also cleared the doubts and queries of all the participants excellently. You have addressed it very well. And I present a heartfelt vote of thanks on behalf of Valuation Standard Board of Institute of Chartered Accountants of India. Thank you very much, Apeksha Ji and CAJ. And a heartfelt thanks to our Chairman, CA Hansraj Sir, and Vice Chairman, CA Preeti Savla Ji, for their great efforts in arranging Valuation Manthan sessions on regular basis for the benefit of all our existing as well as aspiring professionals. Unfortunately, today our Vice Chairman, CA Preeti Madam, could not make for the session today. And we are unfortunate to just miss her kind words of motivation and encouragement. Thank you, CA Hansraj Sir and CA Preeti Madam, for all your efforts. Also like to present my gratitude to all the participants who were, without whom this session would not have been a success. So with this, we come to an end of today's session. Have a great Sunday. Goodbye.